Hello, Steve Lentz here with Discover Options, and welcome to this presentation of several market reports for advanced options traders. This is for Friday ending August 18th, getting ready for Monday, the open on the 21st. Presented material today is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. So today for the advanced option traders, we have the S&P 500 Condor Butterfly Timing Report for those of you that use those strategies to collect premium in a market-neutral fashion. Some like to sell premium with a bullish leaning using bull-put spreads, selling puts maybe a standard deviation away out of the money. And for those folks, we have the bull-put spread timing report for the S&P 500. And then finally, the directional likelihood report for the SPX answers the question, based upon historical incidences of today's current market condition, what's the market likely to do? So we're going to get to that as well. If you can subscribe, that'd be great. Just click on the button for the subscribe button. And then also, for those of you that have not gotten this book yet, we have an ebook, Simple Steps to Options Trading Success, co-authored by Jim Graham and myself, Steve Lentz. And just click on the link, fill out the information for us, and we'll get you that free ebook real fast. Let's go to the market condition as of Friday. You'll notice here that we are definitely below the 50-day simple moving average, so the trend is down. We have two consecutive downswing bars with lower highs and lower lows. That occurred when the stochastic, the 15-3 stochastic, is it's roughly around 20 right now. It's greater than 0, less than 40. All that, the price action trend and the stochastic condition, all contribute to a market condition that has occurred roughly 300 times, including consecutive occurrences, from January 2000 to the present. Non-consecutive occurrences, like what you see here on the screen, those three occurrences, there's been about 180 occurrences non-consecutively. Okay, so we have a good data sample here. This is quite a few occurrences, so that's good. Let's go to the first report, which is for the Condor and Butterfly traders. So since January of 2000, there have been over 4,400 daily closes of the SPX. Okay, now of those 4,400, 65.6% have been favorable bars for selling premium, where the actual 21 bar movement after that was less than what was being implied by the SIBO skew-adjusted VIX. Okay, so you have two things going on here. The SIBO skew-adjusted VIX says there's going to be a certain movement in the future. It predicts a certain movement. And then what actually happened was less. The 21 bars subsequently was actually less than what was being implied. That's a favorable thing to occur for a Condor Butterfly trader. Okay, so 65.6% is the baseline that worked out to be favorable. Now, also during that time, just since January 2000, our current market condition that we just described has occurred 304 times. Now, of those 304 times, 53% of the bars have been similarly favorable for premium selling. That's a lot less than the baseline. So this implies a selling edge, a premium selling edge of minus 12.6%. Okay, is that right? 12. Let's see, 65.6. 12 should be 12.4, maybe. Yeah, maybe 12.4. So statistically, it's more likely than usual that the current market condition will end up being unfavorable for market neutral option premium selling. Does it mean that it will be unfavorable? No. 53% of the time of the 304, it worked out fine. But the baseline is much higher than that. And so if you have a Condor Butterfly adjustment approach that can weather big movements, looking at almost 47% of the time to weather strong market movements relative to the implied volatility, that's a lot. All right, that's almost half. So if you have an approach that can weather the storm when stormy times half the time and not get beat up, that's awesome. Okay, but right now we have a negative edge, and so that's the Condor Butterfly Timing Report. Now, for those of you that trade from a bullish perspective, selling puts may be a standard deviation away, 30 days out, maybe using hedged bull put spreads, or even using condors and leaning on bullish. Various ways of doing that. So here's the report here. So since January of 2000, there have been 4,456 daily closes of the SPX, to be exact. Of these, 82.9% of the bars have been favorable for selling put premium a standard deviation away 30 days out, where the actual movement to the downside, 21 bar downside movement, was less than what the SIBO skew adjusted VIX was saying. All right, so 82.9%, almost 83% of the time. In other words, if you flip a coin 100 times on average, 83% of those will be fine for selling those puts. Just simple random picking. All right, now, but during that time, our current condition occurred 304 times, like we said. Of those 304, 79.6% of the bars were favorable for premium selling now. So this implies a put selling premium edge of minus 3.3%. So again, a negative edge for selling premium in the puts, a standard deviation away. Statistically, it's more likely than usual that Friday's bar will end up being unfavorable for selling put premium out of a standard deviation out of the money. Okay, so not looking good for the premium sellers right now. Might want to wait until things calm down a little bit and it'll turn around here. Let's go and look at the market likelihood report. What we do here to answer the question based upon the current market condition, based upon the historical occurrences of our current market condition, what's the market likely to do? All right. To answer that question, we use price distribution bands. Price distribution bands. And I like to use 3 to the upside, 3 to the downside, 5, 10, and 15 days out. All right. And we're just we're going to take a historical look at how often price strikes those bands 5 days out, 10 days out, 15 days out. And we take a measurement here. Let me show you. So here's an example of 5-day bands. And so here's the the band to the upside 5 days out, standard deviation based upon the SIBO skew adjusted VIX. And there's the 5-day to the downside. Notice that the upside is closer to the close than the downside. And that's because when I say SIBO skew adjusted, I'm using the SIBO skew number to make the VIX asymmetrical, because the out-of-the-money calls have a lower implied volatility than the out-of-the-money puts in the SPX. And so that's reflected in these distribution bands. And the question is that for this bar, over the next 5 days, will price strike the upper, the lower, or neither over the next 5 days? And we keep these statistics on these bands for the 5-day, the 10-day, and the 15-day distribution bands. And then the statistics are compiled at the top up here. So out of 4,456 occurrences, the upper band was struck 21.4% of the time, the upper 10, 15.8%, the upper 15, 14.7% of the time. The lower 5-day band was struck 16.7%, 16.9%, and 19.6%. Okay, so that is the market. That's what the market is saying is the prediction as to where the market is likely to go on the upside and the downside, a full standard deviation. Now, let's take a look at what happened under our current market condition. So these are the benchmark numbers here. Okay, as I said before, we've had 180 non-consecutive occurrences of our current market condition. Now, of those 180, the upper 5-day band was struck 22.8% of the time, which is a little bit higher than benchmark, and that's why you see a blue number, plus it's 1.4% higher. The upper 10-day band was struck 25% of the time, 9.2% higher than the benchmark. You see that? And then the other bands, similarly, were struck more often than the benchmark. Look at that, of those 180. Now, what I like to do is say, okay, look at Friday's bar, and if price on Monday ascends above Friday's high, what's the distribution then in that occurrence? And so we've had 108 incidences of price extending above Friday's high, and of those 108, all 6 of the bands were struck more than the benchmark bands. And you can study those yourself. Look at how much, some of those were hit far more often than the benchmark. We've had 102 incidences where price descended below Friday's low, the previous day's low of our current market condition. And in all 6 of the bands in that case, again, more striking of the bands more often. This is a picture, folks, of more market volatility, higher levels of market volatility than what's being predicted here. Does it mean that does it mean that we are in for a rough time? No. You could see clearly there's been a strong percentage of the time. You can just see between the upper and the lower, 29.6 plus 17.6. Let's see, 30, 47, not even 50% of the time. So a little more than 50% of the time, market stays within the boundaries of the 5-day bands. And then you can kind of just do the raw numbers yourself, but you'll see a strong even out 15 days. Well, let's come up here. 24 plus 21. 44, yeah, 40. So that's still over 50% of the time it stays within the band. So, what we're saying here is that the statistics are showing that it's more likely than usual that the market will be a bit more rowdy, so to speak. So it doesn't mean that it absolutely will. The statistics just show that it's more likely than normal that it will be rough sailing ahead. Okay, so that's it for the set of reports we had for you today. Let's see, click here, click here, click here. All right, good. I'm Steve Lentz with Discover Options. Thank you for viewing this. We'll see you next week. Bye-bye.